Emerging markets are cutting their rates in order to stimulate growth in their economies. Why isn't Ghana following suit?
In the last MPC meeting, they were a bit concerned around the impact that the recent fuel price increases in Ghana would have on headline inflation. Hence, they decided to take a bit of a wait-and-see approach to see how that translated into annual price growth, i.e. inflation. But by our measure of core inflation, that's relatively stable. So we actually see that there's a bit of an opportunity for the authorities to focus a lot more on economic growth and not necessarily on inflation, because while core inflation is relatively stable. If we look at the second quarter GDP numbers, that came in at 5.7% relative to first quarter that came in at 6.7%. So there's a bit of a slowdown. But what really concerns me from a growth perspective is that it's actually now below trend or potential growth by our calculation. So there is some room for the authorities to actually start boosting economic growth. So we see scope that they should actually focus on the two levers that they have on hand, which is monetary policy and fiscal policy. From a fiscal policy perspective, there's not much room to actually boost expenditure simply because they're trying to ensure that they don't blow their fiscal deficit relative to GDP, which they've capped at 5%. So they're currently running at about 4.5%, so there's not much room there. So they can actually focus now on monetary policy. And if you look at the real policy rate relative to inflation, that's sitting at 6.5%. Now that is considerably higher than the SSA average of about 4.5%. So compared to their peers, they do actually have room to actually cut rates in order to actually stimulate their own economy. So we actually see that in the next MPC meeting, which is going to be coming up in November, they could actually cut rates by about 100 basis points, which would then support private sector credit extension and by extension, economic growth. That's where we sort of are at this stage.
100 basis points. We saw the Bank of Ghana actually doing that in January this year, and financial markets reacted quite aggressively. How do you think they'll react this time around if the bank does cut?
Yeah, I mean, the cedi did weaken quite aggressively there, and I think it took everyone by surprise. I mean, we saw the cedi sort of reach the 5.5 mark in a relatively short period of time, and that was a function of several things. At that stage, the FX reserves weren't as high as they are now, so the intervention levels couldn't be as aggressive as they would have wanted to. Soon after that, we saw the authorities issue a Eurobond net of about $2 billion, so that really shored up their FX reserves. So what we've seen since then is that they've become a lot more predictable in terms of how and when they actually intervene in the markets by supplying dollars when the economy actually needs it. So I think that's a significant point of departure there. And also the fact that offshore investors in the local currency bond market have significantly reduced over the last couple of months. So if we do see that 100 basis point cut, I think the reaction will be a lot more tame compared to what we saw at the beginning of the year.